The views expressed on this podcast are those of the participants, not of Reuters News.
I mean, it feels almost absurd to use familiar words like uncertainty when what you're talking about is potentially the complete devaluation of the U.S. rule of law. I mean, this is not a hurricane. This is not even a pandemic. These are potentially major and permanent changes to the largest economy in the world and how it operates on the most fundamental level.
The euphoria is already waning. We are now 2 months into the new administration of President Donald Trump, and for the most recent half of that time, the direction for US markets, and the mood among executives, frankly, has been down. As we head into the open on Wednesday, the S&P 500 index has fallen roughly 9% from its peak on February 19th. Strategists, the likes of Goldman Sachs, began 2025 touting the invincible story of American exceptionalism, buoyed by the seemingly unstoppable momentum of domestic markets that accounted for roughly 2/3 of equity market capitalization globally. Now, a recent Bank of America investor survey starkly points to the end of that narrative as investors flock elsewhere. Why this is happening and the troubles it points to are the focus of this week's Viewsroom. Welcome back to the Viewsroom, the weekly podcast that invites you, the listener, into a lively debate with my fellow columnists about the biggest stories of the week. I'm your host, Jonathan Guilford. It's hard not to feel that what began as creeping nervousness over the Trump administration's wildly swinging trade policy is now gathering steam, becoming something much bigger. Various economic indicators are dipping into the warning zone, consumer sentiment is slumping, and yet, in a twist that seemed unthinkable just weeks ago, stock indexes in Hong Kong and Europe are charging ahead. Nonetheless, companies are still pushing into the breach. Payment processor Klarna, AI cloud computing company CoreWeave, digital health services provider Hinge Health, a bevy of tech firms are still eyeing IPOs. The big question, will recent volatility be a passing phase, or will the deepening of the trade war and deteriorating conditions nix the hopes of corporate America? With me to discuss what's going on are Gabriel Rubin, who's been keeping an eye on the deteriorating US picture from Breakingviews' Washington, D.C. bureau, and Hudson Lockett, who's been covering the recent swings in Asian markets. Gabe, Hudson, welcome back to the Viewsroom.
Good to be here.
Good to be here.
Gabe, maybe we should start with you. It's kind of a lot to ask what's happening with US markets right now. Kind of a choose-your-own-adventure given the noise coming out of the Trump administration. Maybe it's worth stepping back and just taking a look at some of the lower-level data about what's actually going on in the US economy right now. We have the forecast from the Federal Reserve Bank of Atlanta showing a 1.8% predicted annualized GDP contraction in the first quarter. Is everything pointing in that kind of grim direction, or is it a more mixed story?
So the picture isn't quite as dire as the Atlanta Fed number suggests, but the reason for that reading is actually really interesting and can tell us a lot about the current situation. So currently, the Atlanta Fed's GDP Now number, which attempts to figure out what GDP is going to be for the rest of the quarter and for the rest of the year, using current inputs, it's currently showing a 1.8% drop in the first quarter of 2025. Now, obviously, that would be recessionary-style conditions, a very bad situation for the U.S. economy. And while things are bad, other sort of private prognosticators, forecasters are not picturing it as nearly as dire as that picture. The reason for that is because imports were moved up so much to get ahead of trade restrictions, which really screwed up and exacerbated the U.S.'s trade deficit for the month of January. So the goods trade deficit went up to a record in January, and that was largely just the companies trying to get ahead of these tariffs. $131 billion goods trade deficit is not what the U.S. usually sees in a single month. So other forecasters, Goldman Sachs, JP Morgan specifically, have raised their chances of a recession during 2025. JP Morgan, for example, raised it from 30% at the start of the year to 40% now. So things have certainly gotten worse, but the sort of annualized growth projections for the first quarter are in that 1% to 2% range, not in the negative 1% to 2% range, which some of the projections right now, like Atlanta Fed, are showing.
Right. And does that throw any light on the market moves that we're seeing? Like, I know we always wonder about, is there just like a lot of air to come out of the tires of the big tech rally, or stocks like Tesla, which were valued at these wildly high multiples of earnings? But I was looking at, for instance, FactSet data. It has estimate for Q1 earnings growth for the S&P 500 year over year running at about 7% right now. And that's down from expectations that were closer to like 12% as you get a bunch of companies kind of issuing negative earnings guidance. Like, do you think that's consonant with the story that you're seeing in like underlying consumer data or anything like that?
Yeah, I definitely think it is. Consumer data, we sort of had a good showing for retail sales in the month of February. So that was more positive, a surprise to the upside. But overall, consumer spending in the US, which is roughly 67% of all economic activity, has been down, has been depressed. Not fully depressed, of course, but has been lower than it had been previously. And you're starting to see that in CapEx from companies, and you're just seeing all these uncertainty readings just shooting up to levels that we didn't even see at the start of the pandemic. And uncertainty, leads to fewer deals. It leads to less expansion. It leads to less thinking about the future and less hiring. It might also mean less firing because you really are uncertain about labor demands. But what it really means is that economic activity is certainly feeling the chill of not knowing how to plan for even the next few months in terms of what trade restrictions are going to be and what the overall growth picture is going to look like.
Right. And obviously, there is one person who is the fount of a lot of this uncertainty. But before we get into that, Hudson, I wanted to take a moment here to pull a contrast with what we're seeing over in Asia, because Hong Kong's Hang Seng Index up roughly 23% year to date. It's the star performer globally. Do you want to talk us through a little bit of how significant this move is versus, I think, kind of like Chinese equity markets have been a perpetually sort of disappointing story. Why are we seeing this now?
Sure. Well, I mean, here in Hong Kong, it's extremely significant in the sense that we've had an unceasing expanse of tedium in markets for about 3 years now. So any rise at all is extremely welcome at this point, not just for the secondary market, but also for prospective IPOs, especially cattle, which I believe is tipped to raise about $5 billion this year in Hong Kong. Now, that's all well and good. However, if you look at the onshore benchmark, the CSI 300, which is composed of the biggest stocks in Shanghai and Shenzhen, that is up, I want to say, less than 2% this year. And that betrays a couple of things. One, it's all tech stocks that are kind of riding this DeepSeek wave after the disruption that had on the global AI stock complex. And two, this is a lot of retail money coming from mainland Chinese traders into Hong Kong stocks, which quite helpfully are free of foreign exchange risk because they are all in US dollar pegged Hong Kong dollars. And so even though when you sell out your holdings as a mainland investor, you cash out into renminbi. Even so, that is a pretty substantial benefit, especially if all you have to do is switch from an onshore listing to an offshore listing with the same Chinese company.
That's really funny. So does it make the recent rally almost something like the kind of mirror image of what I think people were worried about in what we were seeing in US stock indexes, right? Which was you had the Magnificent Seven, Tesla, Apple, Google, et cetera, that had these massive rallies, made the S&P outperformance kind of a bit top heavy there. It sounds like what you're saying, cattle, obviously, major battery supplier, huge kind of company undergirding the electric revolution. You have DeepSeek, as you said, kind of proved the viability of AI engineering in a world where the US is trying to crack down on Chinese access to leading edge technology. So like both of those are like, oh, you can actually get a tech rally over in China despite what's happening in the trade war. Is that kind of like, it's just the same mania, it's just going where it has a new outlet, or?
Well, I mean, I think to some extent, I think the wrinkles here are with cattle and the other EV stocks. I think those might be sort of the most robust and sort of with the most solid underlying fundamentals in terms of where the money is flowing right now. In terms of AI, I think that even with Western tech giants, Google's, Microsoft's, whoever, who are actually listed, none of these companies have used AI to revolutionize their own businesses or really add to the bottom line, right? And so if all you have is impatient retail traders throwing their money at stocks here in Hong Kong, if they don't see results soon, that could very easily reverse.
I want to pull a little bit on the idea of the fragility of this turnaround, right? Because the big unsaid thing that we haven't gotten to yet is the trade war. And that's kind of the proximate cause of, Gabe, what you were saying was the huge spike in uncertainty. We're seeing the fact that like indexes of policy uncertainty are running higher than even during the pandemic when the world was shut down is kind of remarkable. But like we are kind of looking at potentially the world partially shutting down some of these trade flows, right? If Trump does in fact push ahead as kind of hard as he's saying. Now, there are a lot of axes along which the US and China and Europe compete, and ideas of kind of tech supremacy, materials access, kind of raw fundamental growth. And I think, Hudson, kind of what you're saying about DeepSeek and the tech rally, it speaks to some of those fundamental issues. But I presume the kind of rising combat over trade barriers is going to be much more short-term, much more visceral in impact. Are there any hints to how we might expect some of this to play out?
Sure. I mean, well, so far we've seen some tariffs from China in retaliation to the total of like 20 percentage points of tariff hikes on all Chinese goods from Trump. But China only has about 140 billion of imports from the US to work with there as leverage, right? And so there's $440 billion going the other way. So that's not really a front where they're gonna have a lot of success going toe to toe. We've also seen some non-tariff trade barriers, like recently, I think at least 3 U.S. soybean exporters had their licenses revoked. Sort of a hint of how bad things could get, right? But that is still trade, and China may not want to go down that path too forcefully because it may just invite sort of a direct tariff retaliation in the U.S. anyway. However, I would say that less direct in terms of trade, but maybe more, well, not maybe, definitely more painful for corporate America would be putting the squeeze on American businesses that rely on Chinese markets and manufacturers. So China, in response to the tariff round so far, has banned import of gene sequencers from Illumina, and that has absolutely torpedoed their share price. Now, Tesla, of course, comes to mind as another company extraordinarily reliant on China with their Shanghai megafactory, which is about half of global production capacity. China was also the only market I believe the only market last year that saw a rise in sales of 9%, while the rest of the world was on the downtrend. And it would be very, very simple to make life very difficult for production in Shanghai on Tesla. The other big name there is Apple, which is both dependent on Chinese factories to make most of the iPhone and actually gets about 1/5 of its revenue annually in China. And so putting the squeeze on either one of those could make things very bad very fast for some of the most valuable companies on the face of the planet. If those threats / follow through don't work and we get 60% tariffs from Trump, there is still the option to let the yuan depreciate quite sharply, maybe 10% or so. And we may also see export restrictions on rare earths, though that could get pretty complicated and hard to manage pretty quickly.
Right. And I mean, Gabe, from the US perspective, obviously it's hard to pass through a lot of this because the initial fights started so oddly low stakes, but that's ramping up fairly quickly and expanding out from just targeting North American allies to now being globalized. Like, From the US perspective, like, how do you think we end up weathering a real deal trade war that just keeps spiraling from here?
Well, the spiraling is what I'm most concerned about right now, because up to this point, there have been sort of bilateral fights. It's Trump has been able to get on the phone, or more accurately, the leader from the other country has been able to get on the phone with Trump, whether that's Claudia Sheinbaum in Mexico or up until this point, Justin Trudeau in Canada. Now it'll be Mark Carney, of course. But you had these sort of last minute deals that forestalled tariffs by a month or excluded a particular industry, the auto industry, for example. That is going to be a lot more difficult when you're imposing reciprocal tariffs on every trading partner across the globe, and especially when you're doing so in a way like what Treasury Secretary Scott Bessent has suggested, which is sort of simplifying that into three, perhaps, tiers of tariffs in terms of who, different restriction levels for different countries. That's, while it might sound simpler to impose, might sound simpler on paper, it's probably simpler for, the Trump trade staff, the National Security Council, or the U.S. Trade Representative staff to sort of go through all those countries and all those trading relationships instead of deciding, we're going to put a 15% tariff on Peruvian avocados because, they have a similar one on a U.S. good. They can just sort of go in and say, Peru, you're orange or you're red. Therefore, you have a particular tariff on you. And so you just get this very difficult situation to sort of negotiate your way out of, because it's not clear who the negotiating partners are and what they're negotiating for and against. So with none of those parameters defined, you're going to have a very hard time sort of lifting trade barriers in a way that produces some sort of result, some sort of actionable win, some sort of ability for Trump to get on TV and say, the X country is putting 10,000 National Guard troops on its border to prevent the trafficking of fentanyl. I guess my point here is that there are so many possible variables put into play when you're essentially sanctioning every trade partner you have, that it just feels harder to extricate the US from that situation and leads to much more risk of a real global downturn. With all of these, really important and sort of not even fully understood trade links essentially severed overnight, perhaps.
Right. And I feel like part of this is you're passing through this in a somewhat rational way that assumes certain rules of the game, and like everybody wants to be able to analyze this in a way that is legible to us and makes sense from how we understand the policymaking process to go. But I just, at the end here, wanted to pick your brain on the idea of, we have continually escalating norm breaking from the Trump administration. At home, we're seeing the firing of nominally independent members of government commissions. We're seeing, I think people are beginning to ask questions like, oh, does this begin to, in the long term, threaten Fed independence or something like that? I mean, that's got to be some sort of overhang for markets, right? Even if it's something that's not being fully metabolized yet.
Yeah, I mean, it feels almost absurd to use familiar words like uncertainty when what you're talking about is potentially the complete devaluation of the US rule of law. I mean, this is not a hurricane, this is not even a pandemic. These are potentially major and permanent changes to the largest economy in the world and how it operates on the most fundamental level. Sorry to put it in those extremely, broad and important, impactful terms, but those really are the stakes here. If you can't depend on Fed independence, if you can't depend on, U.S. government debt, if you can't depend on the contracts that the U.S. government signs with its suppliers or its trading partners or its military partners, frankly, you just aren't operating in the post-war world order that we have come to know and possibly love and possibly not love over the past, 80 plus years. So uncertainty really doesn't even begin to sort of describe the risks that we face during this era.
Perhaps U.S. markets are simply awaiting their Minsky moment on the rule of law. But yeah, honestly, that's a great place to wrap it up. Gabe, Hudson, thank you so much for joining me.
Thanks for having us.
Good to be here.
Thanks for tuning in. This podcast was produced by Oliver Taslich in London. You can listen to a new episode of The Viewsroom every Thursday on the Reuters app or your favorite platform. And don't forget to tune into our sister podcast, The Big View, every Tuesday, as well as other great podcasts from the Reuters team. If you like what you heard, please follow The Viewsroom and let us know what you thought. And check out our views on the biggest stories in business and finance every day at breakingviews.com and reuters.com.